Hello everyone, it's 10 a.m. on Tuesday, April 7th, 2020, and this is 10 on Tuesdays. I'm Holly Hoffman, your host and the CEO of the Sales and Income Tax Advisory Network. For the last 8 years, I worked for the Wisconsin Department of Revenue as a field auditor, head of the Wisconsin Department of Revenue Speakers Bureau, and a technical tax law specialist. I absolutely love what I do, and I'm so happy to be able to work directly for you. So welcome. I'm very excited about this weekly webinar project. I invite you to join me at 10 on Tuesdays to have a casual chat about a variety of business topics. We have a Facebook group, 10 on Tuesdays, and I hope you join so that you can suggest topics of interest to you and to further discuss things we talk about on the webinar. Today's show is about managing sales tax registration requirements when you have sales into other states. So my format includes a webinar for you to reference. You don't need to follow the slides. I invite you to grab a cup of coffee, put on your headset, earbuds, and do some light work while listening. And these will be recorded and made available to you. So if something caught your attention and you need to revisit the topic, you can look at the reference materials on the slides and listen to the information again at your leisure. So today, talking about managing sales tax reporting requirements in other states, we're going to talk first about physical nexus, then economic nexus, and then I'll provide some resources. So the first question is, do you make sales into other states? And it seems like a simple question, but I think people don't realize all the things that they do and all the activities that might be considered sales into other states. So do you have customers that receive your product at their location, which is in another state? Do you have sales drop shipped directly from the manufacturer to a customer in another state? That would be sales into other states. If you make online sales to customers in other states, or the customer downloads product in another state, that may be, we'll talk about marketplace providers and sellers next week. But if you're the one selling the product, it's not through anyone else, and you're making the sale online, that would be a sale into another state. Services provided in another state, including if you are renting rental equipment and it's used in another state, or repair services that are provided in another state, that's going to be a sale into another state. If you are a contractor and you hire subcontractors who do the work in another state, but you're the one billing the customer for the subcontractor's work, that's providing a service in another state. You're making a sale into another state. Agent making sales on your behalf in another state. It may not be your specific employee, but they're working on your behalf, selling your products. So let's say at this point you've determined, yes, you in fact make sales into other states. The first question that you need to answer is whether you have a physical presence in the state that you make sales in. This map shows the states that require you to register for sales tax if you have a physical presence in that jurisdiction. So as you can see, it's most states. And Alaska is not lit up here, but that's because the state level doesn't have a sales tax, but jurisdiction level, the municipalities do. So there is a physical presence requirement in that state as well. It's just jurisdiction level, not state level. What creates physical presence? So some things that create physical presence in another state would be if you own property in that state, whether it's a retail store, a warehouse, or even inventory. It could be inventory located at a fulfillment center. If you own the inventory and say it's located at an Amazon fulfillment center, you don't own the building, but you own that inventory and it's located in that state. That can create a physical nexus. If you have an office, including you have an employee who works from home and their home office is located in that other state. That creates physical presence. Presence of traveling salespeople or representatives, including attending conventions or trade shows where you take orders or make sales from that trade show, providing seminars and training, conducting business regularly, for example, meetings. Say you have some relation to another company, maybe it's an affiliate or something else, and you regularly provide training or have meetings in another state at that facility. That can be conducting business regularly and might create a physical presence in that state requiring registration. Contractors, subcontractors, technicians, the presence of independent contractors providing services on your behalf in that other state. Again, that's providing a service in another state. That's going to create a physical presence. Company trucks, your fleet making deliveries of products in another state creates a physical presence. You're conducting business in that other state. Again, I mentioned in the previous examples, rented property used in that state by a customer is going to create a physical presence. So if you're physically doing business in another state, you have physical presence. That state, and this has been the rule for many years, if you have a physical presence, you're going to be required to be registered for sales tax. Of course, that's only if you're making taxable sales or providing services in that state, but there is a registration requirement just for that. So step one, you determine that you make sales into other states. The first thing you want to look at is whether or not you have physical presence. If you have physical presence in a state that you're making sales into, you're going to need to be registered for sales tax in that state. So that's the first step of determining whether or not you need to be registered. So the next step, separate, is if you make sales into other states, you've determined that. Do you have an economic nexus? So maybe you make sales into a state, you don't have a physical presence there. Now you want to look at, do you have an economic nexus there? And what is economic nexus? Economic nexus is the result of the United States Supreme Court ruling in 2018, South Dakota versus Wayfair. And that's where the courts determined that a state can require out-of-state sellers, even if they don't have a physical presence in that state, to collect and remit sales or use tax on sales delivered into that state. So that means you no longer just need a physical presence, an economic presence. But what does economic presence mean? So most states have adopted economic nexus laws, means your business is making sales into that state. They're going to consider that economic nexus. However, to be fair and provide some leniency to small sellers, most states have adopted an economic nexus law that provides for a small seller exception. And so then they created these thresholds, and there's two types of thresholds, either a total sales threshold into that state or a number of transactions into that state. And when they talk about transactions, they're talking about invoices, so number of invoices into that state. The problem is these thresholds vary state to state. And so that is kind of the basis of my discussion today. How do you manage? So you know you have sales into states, you don't have physical presence, but how do you possibly know what the thresholds are and when you should be registered in those states and whether or not you have economic presence exceeding the small seller exceptions? So I talked about there's two possible thresholds. Total sales, let's talk about that one first. So generally, states require a sales tax registration for total sales into the state. The basic level is $100,000 of sales or more. And when I talk about $100,000 of sales into the state, I'm talking both taxable and non-taxable. So total sales into the state. If you have 100,000 or more, that's the basic, that's the lower realm for states. Some states have a higher threshold, so you'll want to check. So you'll want to know which states you do business in, and then kind of get an idea of what the thresholds are. Some states have a higher threshold, 200, 250. New York has a $500,000 threshold. So if you're making sales into New York State, just know that you don't have to be concerned until they exceed 500,000. Again, total sales includes both taxable and non-taxable sales. And then one thing you need to be careful of when you're calculating, I said it includes both taxable and non-taxable sales, but some states, that calculation of whether or not you meet the 100,000 or 200 or whatever the threshold is, some states allow you to exclude any sales for resale. So if you're a wholesaler or your customers are reselling the products that you're selling into that state, some states allow you to exclude those sales from the calculation of the threshold, which is very important if you're looking at whether or not you need to be registered. So that might be something that you want to keep an eye on. And if all your sales are for resale, know that you're not going to hit the threshold in that state, and it's not going to be an issue. All you need to do is keep in mind, if you do start to make taxable sales into that state that aren't for resale, then you'll want to relook at it. So the other thing is, I talk about you're calculating total sales into that state, but what period are you calculating total sales for? So most states are on the calendar year, but whether they're determining whether or not you reach that threshold based on the previous year's sales, previous calendar year, or your current calendar year might change. They might be different. Some states base it on the previous 4 quarters on a rolling basis, and some on the previous 12 months on a rolling basis. So this may be an issue if you have seasonal sales where you have high periods. Most businesses do have high and low periods of the year in sales. So there might be a period in 12-month rolling basis where you're hitting high periods at the beginning of the 12-month period and the end of the 12-month period that might throw you over the threshold. So just be careful about that. That's one of the things I want to stress on that. The other threshold is number of transactions. Generally, states require sales tax registration if the number of transactions, the number of invoices of sales you make into that state exceed 200. Some states have a lower threshold of 100, but most are at the 200 level. Some states don't even have a transaction threshold, and more states are moving towards that, but it's taking some time to get the legislation changed. I don't know if you're a smaller or medium-sized business, you can have 200 invoices into a state and only have a few $1,000s in sales, total sales into that state. And that makes it very burdensome. So let me just give some background about Wayfair legislation. When the US Supreme Court decided to allow economic nexus to be a basis for states having the right to collect sales tax from out-of-state sellers, they looked at the burden, and specifically South Dakota was the case before them. And South Dakota was the one who set the standard that, hey, we understand this is a burden for small businesses, and that's why they set up the small seller exception. And they felt the 100,000, 200 transaction threshold would be reasonable. And the Supreme Court thought that would be reasonable. As we're finding out, the 200 transactions is not reasonable necessarily. So many states are scrambling to try to adjust that and fix that in their law. So just know that we're going to keep an eye on that, and that's something that should be changing in the future, in the next couple years. That should be dropping off, and it should just go to total sales dollar amount. So again, when you're calculating number of transactions, number of invoices, it doesn't matter if it's taxable or non-taxable sales on the invoice. It would be total invoices into that state. Period used to calculate number of transactions also differs state to state. It will follow whatever the period is used to calculate the total sales. I don't think there's any states that only do number of transaction threshold and not a total sales threshold. I think it's only the opposite, having total sales but not a transaction number. Just a word of warning, Kansas is the outlier, so they've adopted, following the economic nexus rules, and are collecting and requiring out-of-state sellers to register. However, Kansas has no small seller exception, meaning out-of-state sellers, no physical presence in the state, are required to register from the first dollar of taxable sales into the state, regardless of the quantity of transactions. So if you're making sales into Kansas, they're going to require you to be registered for sales tax if you're making taxable sales. There's no dollar limit. There's no number of transaction limit. So just be careful. Kansas is working on legislation right now to create a small seller exception, but that's going to take some time. They're working it through this year. So I told you that you need to monitor which states you're doing business in and what their economic nexus thresholds are. So at what point are those states going to require you to start paying sales tax, be registered, and start remitting sales tax? So don't try to know all the states, just know the states that you do business in. Maybe make a spreadsheet or have some cheat sheet to know the thresholds and the calculation periods for the state you make sales into. Be able to run reports. Look at how you can run reports identifying total sales by state, exempt sales for those out-of-state sales if they're resale or other, because remember I said sometimes the state will allow you to exclude sales for resale and the total sales amount into the state, and find a way to calculate number of invoices by state. So if you can do that and run reports, I suggest just running reports either annually or semi-annually to monitor those thresholds. If you're getting close to a threshold and you see that that state goes on a rolling 12-month basis, I would just keep an extra eye on that one. That's not super common. Generally, annually should be fine for monitoring those thresholds. And then if you exceed the threshold, generally, you're going to be required to register the following period. So the following year, you would need to be registered and reporting. Maintain, regardless if you're required to be registered in that state, if customers in that state offer exemption certificates, or definitely if they offer resale certificates, maintain them. Keep them on file. Definitely, if you're excluding resale sales from your calculations for thresholds, you'll want to have them on file so you can substantiate why you weren't registered. I would maintain those exemption certificates by state, so a separate binder or a separate electronic file from your Wisconsin exemption certificates. Again, just back up. And then if you determine that you exceeded the threshold in a future year, now you have those certificates on file and you're ready to go. When you determine that a threshold is met, you want to look at what period are you required to be registered and start remitting sales tax in that state. So if the threshold is exceeded in the current year, are you required to remit sales tax for, it could be possibly just the following year, that's most common. Some require you to register for the current year, and there's states differ between if they require you to register for the current year, the year you exceeded the threshold in. You may be required to remit sales tax on all sales or only the sales exceeding that threshold. So once you meet the $250,000 total sale threshold, any sales after that, any taxable sales after that threshold is met, you would need to remit sales tax on. Some states may require once you hit the threshold that you register and start remitting sales tax the following quarter. That's those states that require you to calculate on the quarterly 4-quarter rolling basis method. Or some states, the ones that do the rolling 12-month period, may require you to register within 60 days of meeting the threshold and start remitting sales tax from that point on. So be aware when you're creating and determining when to run reports. Just check mark or star the states that have the more immediate registration periods, so that once you get close, or you know that state's going to be close, you know how closely to monitor it. So how do you determine what the economic thresholds are in those states? And this information is available for free online. It's out there. Economic Nexus thresholds and calculation periods for states are available on Avalara.com, and they're also available on the streamlinesalestax.org website. The Streamline has a chart. Avalara has a list of states. You can click on the state and go right to the state. There are more sources out there. These are two that I trust to be up to date. You can also go directly to the Department of Revenue websites. That's more cumbersome, especially if you're doing state sales into, a dozen or more states. But Wisconsin Department of Revenue has guidance for remote sellers, for Wisconsin remote sellers and other sellers selling into Wisconsin. But they have some good resource links on their site. So if you're making sales into other states, again, they are a streamlined state. So they work closely with the Streamline Sales Tax Governing Board. So a lot of their resources are through them. It's really good resources, but that's where you would go. Of course, you can use me as a resource. You can reach me at my website, on my email, or you can call me. Right now, this is my cell phone since I'm working from home instead of my office in Wausau. I am located in central Wisconsin, but I can serve anyone in the state of Wisconsin. Also, I am offering right now a sales and use tax compliance assessment discount for anyone who wants to register an appointment in fall. I'm hoping we're back up and running, but that's kind of like what DOR would do, is come in and audit and look at areas of non-compliance. I can do that in a friendly way, but also look at areas, many of the customers that I've already worked with have found areas for claims for refund and savings where they were remitting too much tax, but it gives you a little bit of security of knowing what you're doing right in areas to strengthen and ensure that when, hopefully not, but if you get audited, that you have substantiation on file and you're ready to go and you understand why you're paying what you pay and why you're not paying what's exempt, and that you have the documentation to support it. So you are in control of your audit and not the auditor. I offer a variety of services. DOR right now, Wisconsin, has not relaxed any reporting requirements for sales and use tax, so just know you must keep filing on time. There is an extension that's always available if you run into difficulties. The extension is a 30-day extension for filing your return. It is not an extension for payment, so just know that you have to still make the payment on your normal deadline, but it just gives you a chance to get your return in after that if you need extra time to prepare it. You just need to request that from DOR prior to the due date. So as long as you get that in, you get a 30-day extension. DOR is still continuing to audit as normal. They're avoiding audits of small businesses, but if you're a medium or large size business, and then some businesses don't meet the small business definition, they're still proceeding audit as normal with those businesses. So it won't be in person, it's remote audit, but just be aware that that's still out there. And if you need any help with that, please give me a call. I am happy to answer questions for anyone. They can contact me for a free consultation or just email a quick question. That's fine too. Next week, I'm going to continue our discussion about out-of-state sales, but not just out-of-state sales, it's any sales through marketplace providers or sellers. And a lot of people don't understand what that legislation is because they see marketplace providers and think I'm not a marketplace. Sales through Amazon or online marketplaces, Amazon would be a marketplace provider. Sales through Uber Eats, if you're a restaurant or a bar that works with Uber Eats and has deliveries or other delivery services, Uber Eats is an example of a marketplace provider. Sales through consignment shops. Consignment shops are selling on your behalf and taking the money from the customer. That is now considered a marketplace provider. So we're going to discuss that next week. It affects more people than you think, but if you're worried about sales into other states, that's the next piece. Do you sell through a marketplace provider? And if you do, hooray, because all the sales tax requirements, audit liability, everything is on that marketplace provider. So it's on Amazon, Uber Eats, the consignment shop. It is not on you, the seller. So that is great news, but you need to understand how it works and what your reporting requirements are for that. So I look forward to talking with you again next week at 10 on Tuesday. Have a good week and stay safe.